Hello, my name is Carlos McWhorter, and today I received a question about Palantir. So someone looked at one of my old videos where I was criticizing Palantir, and they asked me, what are my thoughts now? As if maybe my thoughts has changed as their fundamentals and profit growth has looked pretty good over the past few years. And I told them that my thoughts are largely the same. So in this video, I'm going to take a different approach from my typical stock analysis where I go through the revenues and balance sheet. And I'm going to walk through some of those things, but just in a different way, because I want to just kind of give an update on my thoughts on Palantir and share why I'm one of those people who I'm a fan of the company. And I'm also a fan of the owners, Alex Karp and Peter Thiel. However, I have my convictions and my convictions align with my process, or I should say I have a process and I have convictions about my process and I stick with it no matter what. So that's why I want to do this video. I think this is a very important video. There's going to be a lot of great lessons that I'm going to go over, because what good is a process if you don't have conviction in it? And if you just continue to make exceptions for that process and invest in businesses that don't align with your investment thesis. So here we go. I'm going to go through a few things. First, let's look at the stock activity or the movement over the past few years. So we see that for the 5-year chart, we're 336% up. So that's overall, that's pretty good. Solid uptrend. We had a dip here in the past few years over 2022 and 23, but right now the stock is sitting pretty well. So if you bought in at the low points, congratulations. Excuse me. Let me try this again. So looking at a 5-year chart, we see that they have a total gain of 336% over the past 5 years. That's pretty solid. If you were able to buy during this dip here in 2022 and 2023, congratulations. You have a great gain in a short amount of time. So that's pretty awesome. Right now, this company is at $100 billion market cap. And the PE ratio is 257. It's a very, very high PE ratio right now, selling at $43.69 per share. Now, as we go through this analysis, I want you to think about two things. Number one, I want you to think about the story of the business. What do you think about the business in your mind versus the actual results of the business? And when we get to the shares outstanding, I think this is going to hit hard. I think that's the main lesson of this video. So we'll get to that very soon. Also, I want you to think about what you're getting for the business. Now, of course, when we buy a business, we're buying the future growth of the company, but we want to look at what we're getting for it at the time of the transaction and what that business has to do to make the transaction worthwhile. So I say that because right now the stock is trading at $43.69. I keep forgetting to turn that on. Let's go. $43.69. Okay, pretty solid. But what are you getting for that $43? 17 cents per share. That's an earnings per share. So think in your mind, we're doing a transaction. You give me $43.69 and I give you 17 cents. That's what's happening when you buy a share of this company right now. Now, is that a good deal? It all depends on how fast that 17 cents is growing. That 17 cents is for the year. That's a year's worth of earnings that those $43.69 has purchased. How fast does that 17 cents have to grow, and how consistently does it have to grow at that rate for you to be happy with that transaction? That's investing. That's what you have to think about when you're buying a company. This high evaluation, 257 times earnings, 17 cents per share. So think about that as we go through this analysis. Now, I posted a video some years ago criticizing investment into this company just because I thought it wasn't smart because of the share policy. Just looking at first was back up a little bit. I'm sorry. Let's look at my thoughts on the company. I'm a fan of the company. Like I said, Alex Karp and Peter Thiel. Peter Thiel. I like their writings. I like their books. I enjoy their interviews. They're very intelligent people. Specifically, when they talk, they get me thinking about some things. And I always like listening to people who are intelligent enough to always provoke thought. So I really enjoy them. So I know that impacts people's perception of the business, of what they do. Kind of like Elon Musk, if you think about it. They're really great at controlling the narrative of their business, which is important as a leader of a business. However, when you're an investor, you have to think past that and look at the actual results of the company to get an idea of whether it's a good investment or not. So just looking at a few financial metrics, let's look at the financial growth of the business. So over the past 5 years, this company has had 24%, 47, 41, 23, and 16% growth. Pretty solid, averaging 30% per year annually. That's pretty solid growth. I would consider that a company in a high growth state. That means they're either young or they're in an industry that has lots of opportunity for growth, or they're just taking market share from their competitors. So 30% is pretty solid. I will say that. Looking at their earnings growth over the past 5 years, they had one down year in 2020, but they're averaging 27%, solid as well. So I could say that financially, this company is doing better. The fundamentals of the company is better. The balance sheet is very strong. The debt to free cash flow is really low. Debt to equity is really low. So they're in a great financial position. Just looking at those things right there. Now, their return on capital is still pretty low. This is a company where a lot of people say this is a new company and they have so much room to grow. Some of the qualms I have with it is that this company has been around since 2003. So it's not as new as people assume. I believe they began being publicly traded. They went public in 2019, I think. And people think, hey, maybe they started a few years before, then went public. No, they started over 20 years ago. And they're still in a state where some of their metrics when it comes to their returns on capital, return on equity, aren't where I think they should be as a company that's been around that long. Still well below or well behind many of their competitors when it comes to those things. So even though they're earning money and they're growing, they're improving, there's still some things that I think they have to improve on to convince an investor that invests in my style. So with that being said, they have revenue growth, they have net income growth. Carlos, why are you saying that you're still not investing in Palantir? So here's my main qualm with Palantir. It's the shares outstanding. So when it comes to shares and the share policy of a business can do one of three things. They can buy shares, meaning they're taking shares off the table. They're taking extra cash, purchasing shares and getting rid of them, which in turn increases the value to the existing shareholders. Every time they do that, they give you, the existing shareholder, more of the business. They can do the opposite. They can sell shares, and what that does is the opposite. It dilutes you as a shareholder. If you're bringing more, as I say, you're bringing more people to the party, that's less drinks, that's less food, less space for everyone else. So if you are bringing in more shareholders by selling shares, yes, as a business, you get capital that's pretty much cheap. You don't have, it's not like you're taking debt and have interest payments to pay on that. You don't owe anybody for that money. Basically, it's free money, but to all the other shareholders, you're giving them less. The business doesn't grow just because shares are given or issued, I should say. It's the same pie, same pot of money. More people have ownership to the same thing. So you always have to be careful. Companies that buy shares and reduce shares, they increase your value tremendously. Companies that sell it at a high rate, like Palantir, they are decreasing your value as a shareholder. And I'm gonna show you right here. So from 2018 to 2019, they went from 716 million shares to 1.7 billion shares. That's a 141% increase in 1 year. And from that point, I've been hands off on this company. 141% is very, very high. Now, I understand newer company or in the newer stages of development and they need capital until, revenue and cash flow gets going. I understand why they did it, but just because I understand it doesn't mean I have to sit there and allow my portfolio to be diluted that much. 141% is crazy. Next year after that, they added 65.4 million and went to 1.79 billion shares to over 2 billion, now to 2.2, almost 2.3 billion shares outstanding. So each year they're diluting you by 141, 3.877, and 11.3%. Now, some people may not pay attention to this, but I want you to see something right here. Now, I understand we're talking about pennies, but we're talking about single shares just for illustration purposes. If this company kept the same amount of shares in 2018, 716 million shares, each share would have 29 cents of earnings. But because they kept increasing the inviting more people to the party, I'd say. Each share now owns only 9 cents per share. Now, this is 2023. I believe this rate has increased to 17 cents per share, but it's still the same difference because they continue to issue more shares even since the end of 23. So each quarter of this year, they've issued shares. So they've even diluted you even more as a shareholder. So just for illustration purposes, at the end of 23, that's a 219% decrease decrease in what you can own because of that. Instead of 29 cents, you only own 9 cents per share. So that's the impact. Now, if you think about this, if you were to buy a stock, you hold it for a few years and you're going to sell that stock. Do you want that stock to own 29 cents per share or 9 cents per share? We're going to say 29 because that 29 cents per share, that share gives you a greater opportunity to sell at a profit versus 9 cents because of that dilution. It kills your portfolio. It kills the earning power of the shares you have. When you invest, you want your shares to have as much earning power as possible in the long run. So you may be saying, that's not a big deal. 20 cents. Who's fussing about that? So here's the thing. If you were to own 1,000 shares, that's $293 that you would own for your shares versus 91. If you own 10,000 shares, that's $2,930 versus $913. So this is what you have to consider. This is what you have to think about when you're investing. Am I being diluted as a shareholder, or is the company increasing the value of my shares by buying back shares? So last year, this company announced a share buyback. I believe it was $500 million. $500 million. They announced that they were going to take cash flow, and instead of reinvesting that cash flow into the business, they were going to buy back shares. Now, first I thought, okay, maybe they're trying to reduce the impact of all the shares that they've been selling over the past few years. Okay, that could be a good thing, but why would a company in that stage take cash flow and not reinvest it into the business and buy back shares? That seemed really weird to me. So just to give you an idea of what I'm thinking, this is the curve that shows the normal life cycle of a business. So you have the inception and the hyper growth start or part of the business. Then you get to more stable growth. The mature growth part of the business, to the mature stage, and then the decline. That is the normal course of a business life cycle. So this is what I expect all businesses to follow at some point. Keep in mind that there's no time limit that a company can be in any stage. Think about Coca-Cola. They've been in a mature state for a very long time. King of the mountain, and they'll probably be there for a long time in the future. So this is where a company is. And when you're investing, you have to always wonder or make sure you understand where the industry is and where the particular business is in this cycle. So Palantir is in this stage. I mean, I don't know if I would say they're stable, but they're definitely between the stable or the hyper growth stage, depending on what you look on it. They're definitely not in the mature growth stage. If a company is buying back shares and or paying dividends, that company is saying, we are so confident in our ability to continue to earn cash flow in excess of our needs, both now and in the future. We're going to take extra cash flow and increase the value of the share to the shareholder by giving a dividend or buying back shares. That company needs to be at the very least in the mature growth state. This is where you do that. When you're early in the development stage or the development stages, typically you have so much room for growth in your industry and in your business. You can take money, reinvest it into your business, and return high returns on the capital that you're putting back into your business. This is where companies do that at. You don't see a company pay a dividend here. Think about it. Google just announced a dividend. Very tiny, controversial. Looks like they probably could reinvest that and get more returns out of it. And that might be the best thing for them to do. However, that company that's been around for well over 20 years, they just announced a dividend. Why is Palantir, who's here really announcing a buyback. That doesn't really make sense. So I wanted to look at, okay, they announced the buybacks in 23. So are they actually taking that money and buying back shares? Now, let's look at what they're doing. They're doing the exact opposite. They're continuing to issue more shares by the millions, 47 million, 32, 42, and 14 million from Q3 and Q4 of last year to Q1 and Q2 of this year. They've continued to dilute the shareholders and issue more shares. So why would they make an announcement back in 2023 that they're going to buy back shares, but they have yet to initiate that policy? One thing about buybacks, a company doesn't have to file with the SEC to make an announcement that they're going to buy back shares. Here's what happens. When they announce that they're going to buy back shares, no matter how big the company or small the company is, it's a press release. They do it to impact the sentiment of the investor. If you think about it, they could just do it without saying anything. They could just buy back shares, but no, they want to make the announcement, make investors and Wall Street feel good about the company. Because again, management is saying we're so confident in our abilities both now and in the future to earn extra cash flow, we're going to start buying back shares and increase the value of the existing shares. So they want you to have an improved sentiment and feeling about the business. This is why they do it. But another thing you think about when they do this, how many investors actually go back, look at the cash flow statement and look at the shares outstanding and see if a company is actually taking that, whatever the announcement is, if they say, I'm going to do 10 billion. Who goes back and looks to see if $10 billion were actually used to buy back shares? Now, I don't even do that. I'll go look to see what the trend is, but I never go back and see, hey, what did they announce that they were going to do versus what they actually did. So it's not really a binding thing. It's non-binding. When the company makes the announcement, they can initiate it later on, which is probably what he's going to do. Alex Karp is going to do. He's going to make the announcement and years later start initiating it and probably announce it again. And people are not going to remember that he announced it before but didn't take the action. So it is to improve sentiment and it's non-binding. So anytime you see that, of course, if you see it from a company like Microsoft or Google, they've been doing that consistently and they've continued to announce new buyback programs every few years. Again, it's a press release. You want to keep that sentiment positive. That's also the job of the board and the shareholder and the executives of the company to also keep that stock price up. You know, think about it. If the CEOs and the executives, people in the C-suite, sometimes they get bonuses based on stock performance. So what you think about the company is also their job. They want to control the narrative, and buyback announcements and press releases is one way that they do that. Now, the next thing I would think about when the company is selling this many shares, they are selling shares that bring in cash for free. So companies are doing this when they need cash, when they want to reduce the cost of capital. It's cheaper to do this versus getting debt and paying interest. So what are they doing with the cash? Now, one thing I noticed when I was looking at the income statement, this company had an increase in interest income. 1.6 to 20, pretty high, $132 million in interest income. That's a big increase. Let's look at their balance sheet and find out what that could be. Looking at their balance sheet, I noticed this company Palantir had 2.5 billion in cash and cash equivalents. Sorry, this spreadsheet is acting up a little bit. They had 2.5 billion in cash, 35 million in short-term investments. A year later, 831 in cash, 2.8 in short-term investments. So they took a lot of that cash that they were getting from selling these investments or selling shares. As you see, 2020, they had no short-term investments. So that cash kind of stayed in the cash balance here, and then boom, they invested a lot of this money into short-term bonds. Now, here's why I don't like this. Let's look at the bond rates right now. Now, granted, they bought these bonds over the past 2 years or so, but we're looking at a company that is earning right now. The rates are, between 4.3 to 4.7%. Now, when you look at short-term investments, We're talking about maturities that are liquid. So short-term treasuries, anything that is a year or less, 4.3 to 4.7% on short-term interest or short-term bonds that this company is earning. But again, when we talked about the stages of a business, this is a business that should be able to take money, put it in research and development, put it into a sales team, put it into marketing, put it into either improving their current products or developing new products, and earn a very high return on capital. If not this year, then at least a few years down the road as those products develop and hit the market. But instead of doing that, they seem to be sitting on a lot of cash and earning what I would consider mediocre returns based on what their ability should be, based on what everybody says about this business, what they say about it, the executives, their narrative about their business, and just where the business is in the stage of development. You're in the hyper growth state. Why are you sitting on that much capital when you can deploy it to earn higher returns? That's what you should be doing, in my opinion. Now, of course, there could be some reasons that I don't know that they're doing this, and this could be the right thing for them to do, to sit on this much cash. I just don't like it. Maybe this company is at a stage where they're waiting on some more contracts and revenue to catch up, waiting for some, I would say maybe consumer adoption of their product before they put some more money into R&D and development. Maybe that's where they are. I don't know. It doesn't make sense to me that a company in that stage will sit on that much cash, earning a small amount of interest compared to what their potential should be. So again, these are smart people who are running this business, so that I would assume they know what they're doing. But for me and my portfolio, this is not what I would consider a safe investment. I can't really figure out what they're doing with their capital allocation. They're announcing buybacks, they're not following through, they're diluting their shareholders. It's really, in my opinion, even though the stock price goes up, and that's what people pay attention to mostly, and I get it, it makes sense. You're investing to have more money in the future. So some people are in that position where they have more money. However, the stock is being diluted at a very high tick. Be careful when it comes to long-term holds if they continue to do this. They seem to be slowing down a little bit, but we don't know what they're going to do in the future. I say be careful and make sure that this stock, Palantir, isn't a huge part of your portfolio for that very reason. Again, when we looked at that difference between 9 cents and 29 cents, you want to be selling the shares at 29 cents per share versus 9 cents, if that's your choice. They're going to continue to dilute the shareholder. Of course, they're growing. The revenues are growing. But when that revenue grows, don't think your shares are growing in value at the same rate when they're diluting you. That's the whole point about this video. And I want you to get that. That's why I'm being a little bit repetitive, but I want you to understand the impact to your portfolio long term when the company is doing this. Now, I want you to think about another thing. I am more conservative as an investor. So I know that even though Palantir is growing at 30%, let's say they continue to grow at 30% for the next 5 years, and let's assume they continue to dilute you as a shareholder by selling more shares. A company that's more stable, that will grow at 10% a year, 15% a year, and they have so much cash flow beyond their capital needs, that company that's buying back shares at a high rate has a higher potential to grow. That stock has a higher potential to grow in the next 5 years over Palantir if they continue to sell shares like this. So find those companies that are buying back shares consistently, that are stable, that are in that position where they can easily add value to you as a shareholder, either through dividends and or share buybacks. Find those companies, buy those companies, and rest easy knowing that over time, they're going to do better for your portfolio than companies like this that dilute the heck out of your portfolio. So I hope this video was helpful. Let me know what you think in the comments. All of you Palantir bros, I don't care that you disagree with me. I'm sure you do. That's fine and all, Danny. I just hope you have a process that you're following, that you have conviction and you believe in. It's all good. Holler at me in 5 years when your portfolio's hurting. So hopefully you enjoyed this video. Let me know what you think in the comments, and I hope to see you in the next video.